On January 31st, 2026, gold closed near $4,900 per ounce. Silver was trading around $32. And if you're watching this video, you probably already know that. What you might not know is why those numbers matter more than every other close we've seen in the past decade. Because this isn't about whether precious metals are going up or down. It's about what happens when an entire asset class reaches a psychological threshold that forces everyone holding it to make a binary decision. Stay or leave. And the uncomfortable truth is that most people who think they're positioned correctly right now are actually on the wrong side of that decision, not because they lack information, but because they fundamentally misunderstand what they own and why they own it. Let's start with what actually happened. Gold hit an all-time high above $5,600 earlier in January. That's not speculative, that's documented. Then it pulled back nearly 15% in a matter of days. Silver followed the same pattern, spiking to $34 before falling back below $33. The mainstream narrative is profit-taking. Traders got spooked. The dollar strengthened. The Fed signaled something. Pick your explanation. But none of those explanations address the real question, which is this. If gold is a hedge against instability, and we're living through one of the most economically uncertain periods in modern history, why would a 15% pullback happen right after a record high? The answer isn't in the price action. It's in who owns it and what they think it does for them. Most people buy gold because they believe it protects purchasing power. That's the textbook function. Store of value, inflation hedge, safe haven. All of that is technically true, but it's also functionally incomplete because gold doesn't generate cash flow. It doesn't compound. It doesn't produce dividends or interest or growth. It just sits there, and its value is entirely dependent on what someone else will pay for it in the future. That's not a criticism. That's the mechanism. And the mechanism matters because it determines behavior. When gold rises 20, 30, 50% in a short window, the people holding it aren't thinking about inflation protection anymore. They're thinking about profit. And the moment they start thinking about profit, gold stops being a hedge and starts being a speculation. That shift in psychology is what creates the volatility we just saw. Here's the financial logic. Let's say you bought gold in 2020 at $1,800 per ounce. You held through the noise, ignored the corrections, stayed disciplined. The problem is that most people don't differentiate. They buy gold with one mindset and hold it with another. They tell themselves it's protection, but they check the price every day like it's a growth stock. They say they don't care about short-term moves, but they feel anxious when it drops 10% in a week. That cognitive dissonance creates bad decisions, because when gold pulls back from $5,600 to $4,900, the person who thought they were hedging starts thinking like a trader. Should I sell and lock in gains? Should I buy more at a discount? Should I wait for confirmation? None of those questions make sense if you actually believe gold is long-term insurance, but they make perfect sense if you've unconsciously shifted into speculation mode without realizing it. This is where the concept of profit margin becomes useful, even though gold doesn't generate profit in the traditional sense. Think about it this way. If you own a business with a 40% profit margin, you can afford to make mistakes. You can lose customers, absorb cost increases, weather downturns, and still survive. But if your margin is 5%, every tiny variable kills you. Gold is a zero-margin asset. It doesn't produce anything. Its only function is to preserve value or appreciate based on external fear and demand. That means your entire return is dependent on timing and sentiment. You can't afford to be wrong about when to enter or exit, because there's no underlying cash flow to bail you out. And right now, after a parabolic move followed by a sharp pullback, the margin for error is incredibly thin. Let's talk numbers. Assume you're holding $50,000 in gold right now. At $4,900 per ounce, that's roughly 10 ounces. Now let's zoom out. The bigger question isn't whether gold goes to $6,000 or falls to $4,000. The bigger question is what role it's supposed to play in your overall financial architecture. If you're holding 5 to 10% of your net worth in physical gold, or a gold-backed ETF as a hedge against tail risk, that's rational. You're buying optionality. You're saying, if the dollar collapses, if inflation spirals, if geopolitical instability accelerates, I want some exposure to an asset that has maintained value for thousands of years. Fine, that's a coherent strategy. But if you're holding 30, 40, 50% of your liquid net worth in gold because you think it's the only safe place to be, you're not hedging. You're making a concentrated bet on a single non-productive asset. And concentrated bets, by definition, increase risk even when they feel safe. Here's the uncomfortable part. A lot of people who bought gold over the past few years didn't do it because of a disciplined asset allocation strategy. They did it because they were scared. They saw inflation hit 9%. They watched the Fed raise rates. They heard talk of recession, stagflation, debt crisis, geopolitical instability. And instead of building a diversified portfolio designed to handle uncertainty, They piled into gold because it felt like the only rational move. That's not investing. That's panic dressed up as prudence. And panic-driven decisions almost always underperform, not because the asset is bad, but because the psychology behind the decision is unstable. When you buy out of fear, you sell out of fear. And selling after a 15% pullback from an all-time high is exactly the kind of behavior that turns a hedge into a loss. Let's compare this to a different scenario. Imagine you're holding $50,000 in a diversified portfolio. 60% stocks, 30% bonds, 10% gold. Same starting point, same time horizon. Over the past 6 years, the stock portion compounds at an average of 10% annually, the bonds generate 4%, and the gold appreciates at 12%. By January 2026, your $30,000 in stocks is worth roughly $53,000. Your $15,000 in bonds is worth about $19,000. Your $5,000 in gold is worth around $800. Total portfolio value, $8,800. Meanwhile, the person who put the entire $50,000 into gold at $800 and held to $4,900 has $8,100. Almost identical outcomes, but with one critical difference. The diversified investor had liquidity, income, and downside protection across multiple asset classes. The all-gold investor had a single bet that paid off this time, but could have easily gone the other way. And more importantly, the diversified investor didn't need to predict the future. They just needed to follow a coherent system. This is the gap most people miss. They focus on the outcome instead of the process. They see gold at $4,900 and think, I should have bought more. But they don't ask, what would I have done if it dropped to $1,000? Because that's the real test. Anyone can feel smart when an asset doubles. The question is whether your strategy would have survived if it didn't. And for most people, the answer is no. They would have sold at the bottom, bought back at the top, and repeated the cycle until they were behind both the market and inflation. Let's bring this back to January 31st, 2026. Here's the framework you need. Every asset in your portfolio should answer 3 questions. 1, what function does it serve? 2, under what conditions does it perform well? 3, under what conditions does it fail? If you can't answer all 3 with clarity, you don't understand what you own. Gold's function is to preserve purchasing power and hedge against systemic instability. It performs well when confidence in fiat currency erodes, when real interest rates are negative, when geopolitical risk is elevated. It fails when opportunity cost rises, meaning when other assets offer better risk-adjusted returns. Right now, we're in a transitional phase. If you're overweight gold right now, meaning more than 10 to 15% of your liquid net worth, this is the moment to rebalance. Not because gold is going to crash, but because the risk-reward profile has shifted. When gold was at 118 and everyone was terrified of inflation, the asymmetry was in your favor. The downside was limited, the upside was wide open. But at $4,900 after a parabolic move, the asymmetry has inverted. The downside is now significant, and the upside requires either sustained currency collapse or a continuation of fear-driven buying. Neither of those is guaranteed. And when asymmetry flips, discipline says you take chips off the table. This doesn't mean sell everything. It means recognize the change in probability. If you bought gold at $2,000 and it's now at $4,900, you've made a 145% return. That's real. Lock some of it in. Move 20, 30, 40% of that position into productive assets that generate cash flow, stocks that pay dividends, real estate investment trusts, bonds with real yields, anything that compounds. Because compounding is the only mechanism that reliably builds wealth over decades, and gold doesn't compound. It just sits there, waiting for fear to drive the price higher. And fear is a terrible foundation for long-term financial strategy. Here's the final piece. The reason January 31st matters isn't because of the price. It's because of what the price represents. We're at a psychological inflection point. Gold hit a record high, pulled back. If you're sitting on a concentrated gold position right now, ask yourself this. Would I buy the same position today at this price if I were starting from zero? If the answer is no, then you're holding out of inertia, not conviction. And inertia is one of the most expensive forces in finance. It keeps you in losing trades because you don't want to admit you were wrong. It keeps you in winning trades long after the risk reward has turned against you. It tricks you into thinking that doing nothing is the same as being disciplined, when really it's just avoidance dressed up as patience. The truth is, most people don't need more gold. They need more clarity. They need to understand the difference between hedging and speculating, between protection and profit, between fear and strategy. They need to stop checking the price every day and start thinking about what they're actually trying to build. Because wealth isn't about picking the right asset. It's about constructing a system that survives every scenario. A system where gold plays a role but doesn't define the outcome. a system where you can afford to be wrong about any single position because the overall architecture is sound. January 31st, 2026 was just another close. Gold at $4,900, silver at $30. Nothing changes today. But everything changes if you let this moment force you to think clearly about what you're doing and why, because the people who win over the long term aren't the ones who pick the perfect entry or exit. They're the ones who understand their own psychology, build around it, and never confuse a good outcome with a good process. The price will do whatever it does. Your job is to make sure you're positioned to benefit regardless.